Well, markets largely trod water last week as participants enjoyed the last few days of the summer break, though we saw a continued steepening of the Treasury curve and continued gains in the precious metals complex as well, with gold certainly starting the week on the front foot and looking set to print new record highs as well. That all comes as President Trump's attacks on the Fed continue, this time with him trying to fire Governor Lisa Cook, and that ending up in what looks to be quite a long-running legal case. Turning to the week ahead, focus will fall largely on Friday's US labour market report, which is going to be key in determining how the Fed frame what is now seemingly an inevitable 25 basis point cut at their September policy meeting. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. So without further ado, let's crack on with the show. So trading conditions weren't exactly thrilling last week as August drew to a close, but hopefully the start of September, the end of summer, the return of more market participants after the Labor Day holiday might invigorate things a little bit as the new trading week gets underway. Joining me as always to try and make sense of everything that's going on is the man from the milk tray advert. Oh, no, it's not. Sorry, it's Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. And let me just say right from the get-go, no football chat this week.
What do you mean no football chat? I was looking forward to it. It seems we had our first win of the season and you got beaten, but no. Instead, I'm going to feel invigorated about coming back after the summer break.
Well, there we go. We've both had a week off, and it seems like everyone else in markets took a week off, given that not much happened last week. But let's hope that things change on that front this week, and why don't we discuss it all in Topical Thunder? Okay, so what do we have on the docket this week? Well, we've got to wait until Friday for the main event of the week, and that is, of course, the latest US labour market reports, including the non-farm payrolls print. And I'm sure, there we go, the graphics have finally caught up with us. It does feel like centuries ago now, not that the graphics changed, but that Chair Powell made his dovish pivot at the Jackson Hole Symposium. That was a couple of weeks ago, where Powell shifted to the idea that tariffs are going to be a one-off change in the price level and that they don't necessarily pose the risk of more persistent price pressures. And Powell also pretty explicitly planted his flag in the camp that he is going to deliver a rate cut in September, noting, and I quote, "the shifting balance of risks may warrant adjusting policy." Now that means that the debate has moved on from where we were in our last show, which was, will the Fed cut in September, to will it be a hawkish or a dovish cut in September? I think it's pretty much guaranteed that they move by 25 basis points. A 50 basis point cut seems wide of the mark, given the lingering inflation risk that we do have. But the Fed don't seem worried about that. They're going to look through any tariff-induced price pressures. So labour market developments are going to be key in answering how they frame the rate cut that we're going to get next month. In terms of the August jobs data we get later this week, headline payrolls are seen having risen by 75,000 in the month of August. That would be broadly unchanged from the prior 73,000, but do recall, of course, we had that huge 260,000 downward revision to the prior 2 months worth of data in July. So there is the potential for some spiciness in the revisions once more. The other thing to bear in mind is that the break-even pace of jobs growth could be as low as 50,000 now. So even if we get a 75,000 print, we're still above that break-even rate. Earnings pressures there remain relatively contained, rising by 0.3% on the month. Unemployment, meanwhile, that's seen rising to 4.3%, up from a prior 4.2%. But that's not the biggest jump in the world, because the prior print was actually, and I can see Ryan smirking away already, the prior print was actually 4.2479%. So we weren't far off 4.3% anyway. To be honest with you, this all feels a little bit binary, to be completely honest. If we get another soft report, it's going to be a dovish cut in September. It's going to be the Fed resuming that journey back to neutral that they paused at the start of the year. If it's a more solid report, then potentially the framing around that 25 basis point cut in September is going to be a little bit more caveated, is going to be a little bit more cautious, but I don't think anything we get in the jobs report is going to derail the idea of a September cut completely. Frankly, you can make a bullish equity argument either way. Either we get a poor report and we get a rate cut, which juices the market, or we get a solid report, and that means the economy is ticking along fine and earnings growth should remain resilient as well. Ryan, I see you were smirking about the decimal places I was going to there. I'm hoping you can add some more value along those lines.
Well, I'm certainly not going to add a few more decimal places to your number anyway. We go to 3 decimal places for the CPI data. If we get to 4 for the jobs market, I might as well give up this game.
Too many numbers for your little head to compute. Is that the problem?
It's too many numbers that we need to stick our noses into. We don't need to go for 4 decimal places. You don't even have to go to 3 decimal places. It's enough. It's going to be 4.2 or 4.3%. That's all we need to worry about. Traders have enough on their plate as it is. But yeah, everything since the last NFP report has been leading up to this one. It's going to be huge. What if we get a 250 print and a 4.1% unemployment? Is that going to completely change the narrative of a September cut? The market has still, obviously gone that way. It was that way before Powell. We were heavily priced towards a cut in September. And I think it's not so much a 50 basis point cut, I think, is off the table, unless it's a minus 500,000 NFP and unemployment rates of 5% or something silly like that. A 50 is off the table. But what the market is going to be looking for is whether this is going to cement cuts for the rest of the year and going into 2026, because that's really what we're going to be trading now, and I'll explain on that a bit later. I would laugh just for entertainment factor. I'd laugh if we get a 250 print NFP and unemployment rate at 4.1% and hot wages, and then the market's going to have a little bit of a paddy and throw its toys out the pram once again.
Yeah, I think you do have a slightly warped sense of humour there, to be honest, mate. But never mind. Actually, your suggestion there is very much in line with what a good friend of mine and yours, Dario Perkins at TS Lombard, suggested recently, where he was talking about how the Fed could signal a cut at Jackson Hole, and then we see this big move higher in CPI and a really solid August jobs report that leaves them in a complete bind. And you certainly wouldn't rule it out. I think Powell has boxed himself in probably too much after that Jackson Hole speech. And I must admit, I was surprised how, in central bank terms at least, how explicit he was about what they're going to do in September, because that sentence I read out earlier about the shifting balance of risks, he didn't even need to say it. The mere fact that was included in the speech is enough guidance in and of itself. So, yeah, I think it's going to be interesting to see how the market shakes out in the aftermath of jobs data. But of course, that is not the only employment statistic that we have due for release this week.
No, indeed. And we've got a few more employment components and reports coming out this week. NFP is obviously the main jobs numbers, but we shouldn't rule out the market moving on some of the other numbers as well. We get both ISM readings ahead of the NFP. We know that manufacturing has been stuck in contraction for the best part of 3 years. And in the jobs picture as well, the employment component, that's been stuck in a negative for around about 3 years, only the odd move into expansion. Now, services employment also, it's only been above 50 once in the last 5 months, so it too hasn't been looking too good. Really, though, it's still all about this lack of hiring rather than firing, so we're not seeing that popping up just yet. JOLTS is always lagging by a month, but it's a view of vacancies, so that in turn is a gauge of firms' hiring intentions, at least. Since the 2022 highs, it's been grinding lower, but we've stabilised sort of in a 7 to 8 million range for the last year or so. So only a move outside of that will really get the market really taking note of that number. Now, I know you're a big fan of the ADP report, which is on Thursday this month. Here we go. Whatever you think of it.
It's a waste of time.
Waste of time. It doesn't matter. Whatever you think of it, the market will move.
Well, I tell you what I think of it. I'm actually out for lunch on Thursday, so I won't even be on the desk when it comes out.
Oh, shock. You're straight back from holiday and you're off out lunching already. Typical. How the others live. But anyway, the market will move on it if there's a big shock variation to the number. We're expecting 71,000, so it's there or thereabouts of what we're expecting for the NFP. It's also worth noting within that report the sector changes too, because that just gives you an idea of what's going on the ground, which particular sectors may be adding or losing jobs. Now, Challenger layoffs is out on Thursday as well. That's eased off somewhat since we saw the effects of the government layoffs intentions coming into that, around about 350, 400,000 earlier in this year. So the actual confirmation has yet to come through into the NFP data, but we know they may be appearing soon. But in the meantime, it's, as I say, just another metric to gauge whether firms are turning to firing rather than just not hiring. So while the NFP data is the main event, all these other markers can give us a broader overview of the health of the US employment sector. And so with that much focus on jobs, they could be a bit more spicy than usual this week.
Yeah, potentially, although I don't think the ADP number is ever spicy, to be honest with you. It's like a sort of lemon and herb at Nando's, if we're going to put it on that sort of scale. If they want to give some, if I'm giving you free product placement, they can give me a free meal or something now. Anyway, moving on from that.
We're going for lunch, is it, on Thursday?
I should bloody hope not, actually. I'd hope I'm going somewhere nicer, given I'm not picking up the bill. I've completely lost my train of thought now. Thanks.
That's
for that.
all right. It's probably going nowhere anyway.
Where I was, we were talking about the jobs market. No hiring, no firing. That's right. Yeah, and I think that's the way to frame it. That's how the jobs market has been really since April now, just paralysed by uncertainty when it comes to tariffs, the ever-changing trade policies. It's just meant that businesses have really put those hiring plans on ice. And I know this is a debate that we've had before, and it comes back to something that Christopher Waller at the Fed has spoken about. Is fine. Ordinarily, if the labour market is in this sort of inertia, a rate cut or two would help to ease things along a little bit. But at the moment, we're in a situation where the uncertainty or the reason the labour market is paralysed is not because of the cost of credit being too high, it's because of what's going on in Washington, D.C. So you could equally make the argument, now, the Fed are going to cut in September anyway, but is that cut actually going to make much of a difference? Is 25 basis points off benchmark interest rates going to be enough to outweigh that uncertainty and get firms in the United States hiring again? The other thing I would just say very quickly is, and you alluded to the sectoral split of employment in the ADP report. You obviously get that in the BLS jobs report as well. Probably the only sector, or one of the only sectors, that has really added jobs over the last 6 months or so is healthcare. And that's basically mechanical. Every month the population gets older. Every month there are more people being hired in the healthcare sector to basically look after the aging population in the US. And that's true in other developed economies as well. When you strip that out, basically job creation has been flat for 3, if not 6 months. So that's another thing just to keep a bit of a close eye on as we get through all those jobs releases this week.
Yeah, and also, those government jobs that, maybe this month's a bit too early, but we know they're coming at some point, whether it's September onwards, but whether we see something coming in. So if you're trading the jobs report, remember to look at the breakdown as well. If there's a big miss, shall we say, on the number, see where that is. Is it in private? Is it in government? Because that obviously it's a known unknown.
Yeah, the other thing, just lastly on the jobs report before we move on, is August is back to school in the United States. The reason I mention that is because despite it being back to school every single month, every single year, I should say, the BLS, for whatever reason, always seem to make a mess of the seasonal adjustment in state and local government jobs when all the teachers fall off payrolls in June and then they all come back onto payrolls in August. That can make things a bit messy. So if we do get a much higher or much lower than consensus payrolls print on Friday, I would bet a fiver that it be due to the teacher issue.
By the way, what's your number for Friday?
I'll tell you on Friday morning.
Same old rubbish. 186. That's what it's going to be. I can tell you now.
180. Is that your guess?
Yeah, that's 1,000. By the way.
Well, 186 men. Well, there we go. Now we know what the jobs number won't be. You'll have to stay tuned to my Twitter feed later in the week to find out what my guess is. Anyway, moving on to the Fed, because there's been plenty of shenanigans going on there. We're in a bit of a weird time, really, where you sort of look at the Federal Reserve as an institution. You go, actually, trying to figure out the near-term policy outlook is really the easy bit at the moment. What's much harder for market participants to think about and also to price as a risk is all of the shenanigans going on elsewhere, which basically center around the Trump administration's efforts to erode what is left of the Fed's monetary policy independence. And we've had a number of developments on that front. Recently, of course, Trump continuing to call for rate cuts pretty much every day at this moment in time. Treasury Secretary Scott Bessent has joined in on that front too. He was talking the other week about how rates should be between 150 and 170 basis points below where they are at the moment. When he's not doing that, he's busy interviewing as many as 11 people for the next to take over from Powell as chair next May. Firstly, this means that pretty much all of those 11 candidates are going out in the media and sounding as dovish as they possibly can, putting pressure on the Fed to deliver rate cuts. You would also imagine, certainly when these people are interviewed by the president, that sort of unquestioning loyalty to Trump is going to be the number one criteria at the top of the list in terms of who is hired. On which note, Steve Moran, the chair of the Council of Economic Advisors, he's obviously been nominated to the Fed board to fill Kugler's old spot. It looks likely he's going to be confirmed in time for the September FOMC. We're expecting a 25 basis point cut at that meeting. How big of a cut is Moran going to vote for? I mean, God only knows. It could be 100 basis points or something stupid. Obviously, you've also got President Trump trying to fire Governor Lisa Cook over these purported allegations of mortgage fraud. That is going to end up in a very drawn-out legal battle and could get very, very messy indeed, particularly as Cook is still actually working at the Fed. She's not been placed on any sort of administrative leave, so that could turn sour very, very quickly indeed. And then you've got to take that one step further, which is that if Cook is fired, that will then mean that Trump has a majority on the Fed board. You will have Waller, you'll have Bowman, you'll have Moran, and you'll have whoever he nominates to fill Cook's job. That's 4 out of the 7 positions that are held by Trump nominees. Of course, Powell was a Trump nominee as well, but I think for all intents and purposes, we can kind of discount that at this moment in time. And that poses another risk, because what happens at the Fed every 5 years, in a year ending in a 1 or a year ending in a 6, is the Fed board in the February of that year have to approve the reappointment of all the regional Fed bank presidents, Bostic, Collins, all of that lot. Normally, that's a rubber stamping exercise. We never even think about it. In fact, in a decade in the markets, I don't think I've ever spoken about it. The reason why it's important this time is because there's a world I can envisage where Trump turns around in January and goes, actually, of those 12 regional presidents, I don't really like 6 of them very much. So how about I go and nobble and elbow my nominees on the board to vote against their reappointment to their posts? And that, again, ends up in a whole world of issues for the Fed. So there's a lot of moving parts here, but I think it really does boil down to this, which is that if you're not going to do what Trump wants you to do and be the most dovish policymaker you can possibly be, he's either going to try and find a way to force you out, or he's going to make your life an absolute misery such that you might even quit yourself. Now, I would argue that following the example of Erdogan in Turkey when it comes to monetary policy is probably not great at the best of times, but it's certainly not ideal to be doing that at a time when inflation risks remain tilted to the upside as well. And I think the trade here, as all of this progresses, it's certainly not going to be linear, but it feels relatively straightforward in that the dollar will continue to weaken. You'll probably see a continued steepening of the Treasury curve, and you'll probably see participants continuing to buy into precious metals like gold and like silver as well, as we've seen as the new week and the new month has got underway.
Yeah, that's just another bit of input into the trading that we're going to be putting up with for this month. You know, it's enough having the data, big data coming up. As soon as the market's finished adjusting to that, we're going to be getting into the Fed trade. And you're right. What might happen before the next FOMC, the September FOMC? What might happen after it? It's all just going to be a big old mess. And the longer these sort of court cases go rambling on, particularly with Cook, and what that means for the broader picture of what Trump may be able to do with central bankers or Fed governors there, that, as you say, it's just going to continue to erode confidence in the institution, and that's a dangerous line for Trump to take. So I really don't know where it's going with this, and it's going to get really messy.
Good stuff. Well, let's move on to your last topic. I think you're going to give us a bit of trading wisdom, Ryan.
Yeah, we're going to try. I don't know if it's going to be much wisdom, but we'll give it a go anyway. But,
Well, I'll be the judge of that.
I'm sure. Yeah, I know which way you're going to judge it. As the old saying goes, sell in May and go away, come back on St Leger's Day. Has been pretty apt this summer because aside from the odd volatile event and headline, markets have been pretty dull in between. It's something we spoke about a few weeks ago. But that's all set to change this week as the door closes on yet another summer and we get stuck into the rest of the year. So I want to explain why we've had this sort of summer lull and what it means now it's over. For all intents and purposes, it's pretty much a liquidity issue. Big money has just not been active recently. You can see that in the option volatilities and thus a lot of daily market ranges. Yes, we've had some decent event-driven moves, but no big ranges have been broken and prices have tended to revert back pretty quickly after some of those moves. Now, this is where it may start to change as all that sidelined money now starts to go back to work. And the next couple of weeks will really set the trading scene, not just for the rest of the year, but into the early part of 2026. Now, remember, markets trade in expectations for the future more than they trade the now. So big investors are looking at where things are like rates and where they're going to be over the next 3 to 6 month horizon. So if those expectations have been markedly changed by Powell, or whoever else has come along, there will be positional flows that adjust to those changes over the next few weeks. Now, investment firms will want to also put in a strong performance into the latter part of the year, whilst also trying to position themselves for profiting in 2026. One such thing we've already seen this morning, I picked up on, hedge funds have been getting into the option markets and hedging dollar yen for a move below 145. According to a report on August the 26th, puts outnumbered call trading by 4-1. So there's been a lot of hedging going on. Doesn't mean the market's going to move there or these hedge firms are looking for the market to move there, but they're coming back in. They're getting a bit nervous about positions, so they're ramping up the hedging in quite some size. So officially, St Leger's Day is the 13th of September. But this week after the Labor Day holiday, it's really going to mark the start of the rest of the year's trading. So I think you need to buckle up and be ready for both better liquidity and higher volatility, because I think the next 4 months are going to be pretty stonkingly busy. And one thing to look at this week is US yields. As always, I like to look at the 10-year. We've been stuck in this range between 450 and 420. As you can see on the chart there, we're just at the bottom of that range at the moment. This is going to be big this week. If we get a really bad NFP report and we're breaking below that 420 level, we could be heading down under 4% mark and the dollar's going to go with it. So for everything that goes on today, watch this range. This week, watch this range in those yields.
Oh, I was waiting for you to give me a tip for the St Ledger as well. I was kind of hoping that you were going to round off with that. Yeah, it's been a pretty dull last 2, if not 3 months, let's be completely honest. I mean, I think, outside of equities just grinding steadily higher, it's been a bit of a sort of range-bound, choppy mess across the board, really. And whether that be FX, whether that be fixed income, or even in the precious metals complex. And actually, I do start to wonder whether, obviously, we see gold breaking out to the upside, silver moving to the upside as well. Is that the start of what could be more of these breakouts across the board? You look at the 30-year Treasury yield, for example, getting up towards that 5% mark once more towards the back end of last week. Obviously, trade there at close today. The dollar index still lingering around those 96.5, 97 lows that we put in the summer. Are we going to see a break below that level? So we are sort of getting around these sort of key levels. I think, as you rightly say, it's just questioning, firstly, will there be a catalyst to see the market actually put in a decent move? And secondly, what might that catalyst be? Is it going to be the jobs data we get on Friday? Potentially. Is it going to be the CPI figures that we get in a week or so's time? Probably not, given that the Fed are looking through inflation. Is it going to be the September FOMC, where we get not only a 25 basis point cut, but also the dot plot? And obviously that will be key in shaping those expectations into the back end of this year and also into next year as well, around how much further easing the Federal Reserve is likely to be delivering. But yeah, I agree with your fundamental message. Summer's over, the time for lounging around is over. Let's get back to it.
Yeah, well, and you got any hot tips for the St Leger's races?
I don't. Funnily enough, every time I bet on a horse race, it turns out to be a bloody donkey that's running in the colours that I've chosen. So yeah, there's only one ass in that equation, and that's the bloke here, to be completely honest with you. So I am not one to be offering horse racing tips, that's for sure.
Okay, better carry on then.
My non-farm payrolls guesses are better, and you know how ropey they are.
I wouldn't say they're better. They're definitely guesses, wild ones at that.
Oh, you're very uncharitable, Ryan. Right, let's move on to our plays of the day. Okay, so I'm going to be looking at gold this week, very much in keeping with the theme we were just discussing. Actually, gold has spent sort of 3.5 months going absolutely nowhere since the middle of April, start of May, but it looks like that might finally be starting to change. We closed above this key level between 34.40 and 34.45 on Friday, and then we've pushed further higher to within about $15 of a fresh record high as the new trading week has got underway. Appreciate I'm not exactly sticking my neck on the line here, but I certainly wouldn't be too surprised if we saw a break of those record highs in relatively short order. A new all-time high for bullion seems like a question of when and not if at this moment in time, but I'd expect us to push further higher if we do break, given that the bull case is not only a straightforward one, but also a convincing one, as confidence in the dollar, confidence in the US, and confidence in treasuries continues to fade, and also as the Fed embark on a dovish pivot and real yields fall, which helps things along as well. So I would be long gold this week and buying into any weakness if we see it. Ryan, you're looking at dollar MEX.
Yeah, another pair or asset that's been consolidating for quite some time now, and it's been doing so close to major support at 1850, and it's that fact that's getting me nervous about a potential break lower. Now, for good order's sake, I'm still short from the 21 figure, but I've also been playing some shorter term longs off of the low 1850s, but this lack of any real bounce has me worried about being on the long side. So I'm looking at a potential short on a break of 1850, which, as I'm long, will be a stop reverse on my longs to add to my short position. Now, if this 1850 does break, it's likely to be a big break, but it's going to be dependent on how it breaks, and that will determine whether it's going to be big or not. If it's a break on something like, US data or headlines, something sort of short-termist, I'll need to see it confirm that break first. If it's a more natural break, then we could be moving to the low 18s fairly quickly. On the other side, we need to move above this, above the 19 level to really knock out this consolidation phase to the upside. So at the moment, it's still looking weak, but all things to play for.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you as well to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, or if there's anything you'd like us to discuss this time next week. And that is indeed when we'll be back with another episode of The Trade-Off. In the meantime, have a very good week ahead, and we'll speak to you in a week's time. Thanks for watching. Goodbye for now.